Good day to one and all. This is Dr. Sivaraman of IKnowIndices.com. Tracking the forex market together, part 1, between 9 and 9:45 GMT. So we will be tracking the market from now for another 45 minutes, and we will use the live market code page as a tracking tool. I'll give the link for the same. I'll also focus the camera over that of the live market code page. And in the case of Australian dollar, it's trading around 1.0162, 1.0165. 1.0128 is the low, 1.0179 is the high. 34 pips positive net change is seen. So in all the majors and the commodity pairs are showing the USD weakening move. When you refer to that of the cross, 0 GBP is showing with 5 pips positive net change, trading around 83 area. All the way it has come down from 86 to 83 area, and it is trading in a narrow range again because GBP has gained nicely during this particular fortnight when compared to that of Euro. Then Euro CHF, it is hovering around that of 1.22 area, 1.2221, 1.2224 are the current levels, 2211 is the low, 2226 is the high. 7 pips positive net change is seen. Euro yen and GBP, they have been at a lower level in this particular week, and they gained nominally 102.00 is the current level, and with 1 pip positive net change is the case of Euro yen, and GBP yen is trading with about 7 pips negative net change. So in all, you find that subdued moves are seen, and the net changes are less than 30 pips, excepting in the case of Australian dollar, which is showing about 34 pips. So when they make subdued moves of this nature, then we need to watch how exactly they wanted to make further moves. Before going to that, let me explain with the help of the PowerPoint presentation how exactly the market reading has to be done using my system. First of all, we have to understand the market timings followed by that of the players. So currently we are in European session. The session starts by 8 GMT, 9 GMT we are around, and it gets over by 14 GMT. Then 0030 to 7:30 GMT is the Japanese session. 7:30 to 8 is the gap time before the start of the European session. Then 14 to 14:30 is the gap time before the start of the US session. US session starts by 14:30 GMT and gets over by 21:30 GMT. 21:30 to 0030 GMT is the gap time before the start of the next Japanese session the next day. So during the gap time, they are expected to make the false move, because if they gain the levels during the gap time, that means the first 30 minutes they are expected to drop the level. They would have noticed that during the gap time they made a nominal dip and then pumped up from that of the start of the European session. And unlike that of yesterday and day before yesterday, you know that they gained very quickly in the case of Euro. Using some attribute, they just suddenly dropped about 100 pips. 2 days they have done it, and normally they don't do hat trick. That means they don't make similar moves for more than 2 days. So today, invariably, they are not expected to make that similar drop, and they may just pretend as if they may drop, but suddenly they could make the rise. So these session timings, if we follow, then we'll be able to understand during the early part of the session, 1.5 hours from the start of the session and 1.5 hours towards close of the session, they handle the majors, and afterwards in the mid sessions, they handle the crosses. This, if you understand, then you can focus on the crosses if you want to trade during the mid sessions, and if you want to trade in the case of majors, focus during that of the early and the late of each of the sessions. So now what are the things to be considered? So we have to track the market using the GMT time frame, so that 24-hour market cycle could be easily understood. And then you have to identify the gap time, the session start time, the mid-session and the late session, what I explained with the help of the previous slide. Then I given the link for the live market code page. In that, all are available. The live current market rates are there, the low and the high are there, low and the high, and also the net changes are there. I just refer to that as the net change and said that excepting Australian dollar, all other currencies are showing less than 30 pips net change, either in the positive or in the negative side. The numerators are showing positive net change, the denominator currencies are showing negative net change, indicating that they are making USD weakening move. If you come across the mixed moves, like some the numerators showing positive net change, some numerators showing negative net change, similarly in the case of denominator currency, then it is referred as a contrarian move in order to handle the cross. Now they are simply holding the market at a higher level above that of the initial low, what they are set between 2:30 and 3:30 GMT during the Japanese session. So they are expected to make an upward spike. So we have to identify a currency and which has made about 40 to 50 pips spread between the low and the high, what you come across in the live market quote page. If they show more than 50 pips, then if you try to take a position in that, you will be able to make really good swing profit. Otherwise, they may show about 10 to 15 pips profit or negative loss, and that may not give you any sort of earning from that of the trading. Then also refer to the current level, whether it is closer to that of the low or closer to that of the high. So in the case of euro, you know that high is 1.3095. Currently it is trading around 1.3071. So low is 1.3047. So euro is in the middle level. Similarly, in the case of GBP, you find 1.5671 is the low, 1.5705 is the high. But somewhat closer to that of the high, GBP is currently trading with around the level of 1.569498 level. So you have to identify whether it is closer to high, closer to low. Why? When it is in the middle level, avoid taking positions. If they are above that of the high, what you see, and stay there for more than 30 minutes, then you can take a buy above that of the high. Or when they come up to that of the high and start making a dip, you can take a sell around that of the high when the market drops. So you have to identify whether you're going to do a buy and sell trade above that of the high, what they are set, or a sell and buy trade, sell around that of the high and try to close it around that of the low. So this is how we have to differentiate the trades based on the type of market moves they do it. So I'll explain with the help of the next slide what are the type of market moves they make. Then it is easy for us to take a trading decisions. Now with regard to the entry in the market, most of the people, they identify the entry correctly using various type of statistical analysis and also chart study, etc. And they try to make an entry, but the exit becomes the biggest problem for them. And if they fail to exit, then it may hit the stop. That's what happens. So with regard to entry, our system says that within a session, we can buy near the low or sell near the high when the low or the high are not breached 30 minutes from the start of the session or during the late session. As I explained that they handle the majors during the session start and session close time. Then during that particular time, when they breach the high and stay above or breach the low and stay below, you have to identify. If they are not breached the initial high or the low, what they have set, then around the initial high, we can take a sell. Around the initial low, we can take a buy. But today, what they have done is, the initial low was, in the case of euro, was 1.5673, and they went up to 1.3095 and came down to 1.307072. So they made a brief upward move above that of the high and then come to that of the initial high level 1.3070, and they are simply holding it. In the case of GBP, 5687 was the initial high and they are just trading above that. So when they are trading above that of the initial high, what they are set as the initial high around 3:30 GMT during the Japanese session, then we should not sell. They intend to make a rise from there. So at that time, we will try to buy and they make a small dip and then they are expected to make the rise. So the entry decision as a buy and sell trade or a sell and buy trade is made depending upon where the market is staying in after 30 minutes from the start of the session. Then exit is equally important when you have just taken the position near that of the low in a basic trade. Then near that of the high you should exit. And when you are taking a sell position near that of the high, then you should exit near that of the low. But in the event, if they breach the high and stay above, or breach the low and stay below, then what has to be done? I'll explain with the help of an expert. Then, once you have taken the position, when the position starts making profit, when you are taking a buy near that of the low, the position makes profit. Then what you have to do is keep a hedging order or a stop 30 pips below that, and once the position starts making about 20 to 25 pips profit, try to keep stop at entry and remove the earlier stop what you have kept to limit the risk, so that you don't risk anything. When they hit your stop, then you lose only the position, but you don't lose any money. So this is the first step in trading one has to understand. Similarly, after taking a position, if the position is not making profit for 2 hours, but I exit out of the position with a nominal loss, then try to re-enter once you understand that the market is either making a sideways move or an upward move or a downward move. So that sort of reading is very important. Simply holding the position and praying to God that the market has to go up or come down, that might be testing your patience. Then the entry and exit can be fine-tuned by keeping a limit order. Suppose I want to buy here at 1.3065, then I can just keep a limit buy order 1.3065 with 30 pip stop, and when the market is around 1.3072. So about 5 to 10 pips below that of the market, you can keep a buy order, so that when they dip during a small swing, you will be able to fine-tune and take an entry at the lowest level of that particular swing. In the event if the position is not being filled or your limit order is not being filled, then you can modify and buy it about 5 to 10 pips above that after watching for about 10 to 30 minutes after keeping the limit order. So that way you can fine-tune your entry. Similarly, you can fine-tune your exit also by keeping a keeping a limit order near that of the high set for the day. And in case if they come closer to that, you can remove the limit above, but simultaneously you have to trail the stop in the profit making positions. So the market could hit either the trailing stop or the limit, so that you either get a minimal profit or a maximum profit. So that is how you have to exit out of the position. Many of the people, even though the trailing stop facility is available in the trading platform, they don't use it with a fear that it might be hit afterwards, the market might run up. But if the trailing stop is hit, you just wait for 30 minutes, and if the stop level is not making profit, suppose you are taking a sell, that is how the stop fills your buy position. So if you are taking a sell, are you making profit for 30 minutes? You are not making profit, then re-enter buy even at a higher level, then continue trailing the stop in that particular position. So market continues to give trading opportunity that you need to understand. Then avoid impulsive decisions like buy during the rise, and sell during the drop. So this is what normally you come across in the event of a technical trade decision. But technical trade is something different. We can sell below the low and buy above that of the high, provided we identify the type of moves. Instead, during the drop, if we try to sell, then you might be the last seller and the market might reverse. So that you need to understand. And emotional decisions are always detrimental for that of the traders. Now, in the event if the high or the low are breached, then identify what sort of moves they have done it, whether it is a stop and or a false move. They breached the high and come below that of the initial high in less than 30 minutes, then it is a stop. They go up to the high and just come down, then it is a false move. Then extended move is they breach the high and stay above there for more than 30 minutes and continue to rise for 2 hours and then start making the slide. The intentional move is they breach the high and stay above, then every 30 minutes you find they continue to breach the new high and take up the market. And Another one is called extended stop. And during the trend reversal time, what they do is when euro is trading around 1.3069, then suddenly they may drop it to 1.2969 and then reverse in a matter of about 1 or 2 hours back to 1.3069. And that is referred as extended move. Whenever they make an extended stop, and then you could come across a continuation of the rise from that particular level, and they may extend it for another 100, 150 pips. So this you need to understand. This move normally you come across during trend reversal time. The monthly reversal time and the yearly reversal times, you come across this sort of extended stopping, and you should not become afraid of it. They may simply say that somebody has downgraded and things like that. The news will be appropriately released and they could make a downward stopping and then continue rise, and you will become a fool thinking that as per that of the downgrade, the market is expected to drop, but they might be gaining the levels. So this is how in the game you need to understand. A lot of foul plays will be there, and genuine acts will also be there. You should be able to discriminate whether it is genuine or a foul play or a false move. So when they make an extended rise, so don't immediately try to average your sell. There are many people, when they gain levels for 20-30 pips, immediately they accumulate sell positions. Similarly, when they drop every 30-40 pips, they accumulate the positions. Later on, when they make another 100 pips drop, then there will be a margin fear because they have over traded. So in case if you want to do the averaging without a stop, because many of the traders try to do that, you average it more than 100 pips distance from that of the previous entry, so that when you spread the risk nicely, then market cannot come to zero. It can drop about 300 to 500 pips, and then later on it might go up again another 1,000 pips in a long run. So if you understand that and spread the risk, you will be having lesser position with the spread, and when they gain back 50%, you'll have a break even with the average. And even then, if you find a small pullback, you should be able to exit without any loss. But in case if they rise, then you start booking profit from that of the higher level buys, hold the lower level buys for a position trade to maximize the profit until they rise it using a trailing stop. So this way you can use various type of trading strategies. Thereby you will be able to really maximize the profit. It is not that aiming only for about 10 to 15 pips as a scalper or 30 to 40 pips as a swing trader or an intraday trader like about aiming for about 50 to 60 pips. There is no hard and fast rule that you have to stick on to that type of trades. When the going is good, you should be in a position to maximize that. And the main fear for maximizing the profit is many traders think that, okay, euro could go to 1.34, let me buy it at 1.30 and hold it, probably it may visit 1.28, that will be disappointing. But if you try to keep stop at entry at 1.30, and when they gain, maintain a distance of 30 or 45 or 70 pips from that of the market and use the trailing stop when they gain the level, then you'll find that your position continue to hold the profit and you will be able to maximize the profit by this sort of strategy. So basically, one need to understand the trading strategies are very, very important in trading decision making. You can make the decisions understanding the type of moves and understanding the time frames, what they use for different type of moves. And most important thing is that trading strategy. That is, you have to always keep in mind that the market can bring in unexpected things. Use the stop or use the hedging order to limit the risk. In case if you use the hedging order or if the facility is available, what are the advantages of using hedging? How exactly you can come out of it instead of getting struck with that of the hedged position? Because many of the people are afraid of hedging because the market hedge his position and later on moves in line with that of the expectations, the hedging started making loss. Then they do not know how to handle the situation. So if they know how to handle the situation, then hedging is a handy tool for anybody to prevent the the risk factor on the downside or on the upside, depending upon the buy and the sell, and also the risk has to be limited. It cannot be unlimited risk. So hedging can be used as a stop. So instead of stop 30 pips below that of the market, you can keep a hedge order. And in case if the hedging is not filled and the market goes above, you are able to keep stop at the entry, remove the hedging order. There ends the matter. So that you don't need to worry about whether the position is going to be hedged or not. The hedging is used to continue the trade when the market moves in our favor. Suppose you buy at 1.31 in the case of euro and 1.3070 is the hedging. Then they fill the hedging and came down to 1.3017. No problem at all. Let them come down. I'll keep stop at entry at 1.3070 and wait. Once they come back to 1.3070, my hedging will be closed. I'll keep another hedging order below 30 pips below the market and trail it up until 1.3070. I'm able to keep it. And once they go above my buy position, I'll keep stop at entry. So that way you can try using the hedging order in your favor. And if you are smart enough, then you can use the hedging for either way trading. So market has to make necessarily up and down moves. It cannot continuously drop endlessly or continuously rise. So it has to make volatile moves in that particular process. When they drop of the hedging, you can book profit in the hedging like a sell and buy trade. And when they gain back, then you can book profit in the buy side as a buy and sell trade. So either way, you should be in a position to trade, and you can simply keep 150 pips in both the hedged as well as the original positions, the limit, and don't take any excess position and simply watch. You'll find in a day or two or three, both the positions are closed with profit. So trading is really easy provided you understand it well, how they play in the market. And if you do not understand, then comes the difficulty. And if you give more importance to that of the other factors, then the other factors gain your attention rather than the actual market action. Then hedging can be used to reverse the trade when the other way going is good. Say suppose you have taken a buy position at 1.31 and 1.3070, you have kept the hedging, and the hedging makes continuously profit for about 2 hours. Then simply close your buy position with say 40 pips or 50 pips loss and keep stop at entry in the hedging position and let them continue to drop. You maximize the profit in that downside. So you are lost about 50 pips on the closing your buy position. You make about 70 to 80 pips profit in the sell side, and you make about 30 pips net profit and out of the position. Then you can think fresh about the market so that you need not hold the position for an unlimited time frame. Then you might be afraid of the overnight interest charges. Then hedging is used to hold the position and continue trading when time permits. In the event of emergency, we can hedge and leave the trade. Suppose you've got a buy and the market is simply holding there, you simply hedge around the same level. Instead of closing the position, you can close the position, that's also fine, so that you are not worried about the trade. And in case if it is making about 30% profit, loss and things like that, you can simply hedge and just leave the trade as such and go and attend to your emergency work and come back after about 3 hours or 6 hours or 9 hours, doesn't matter, the next day. The positions will be remaining there, and you will be able to understand whether the market is showing profit on your buy side or on the sell side. So if it is making profit on the sell side, then try to keep stop at entry in the hedging order and let them come and close your hedging with stop at entry, then continue the trade on the buy side. So there is no impulsiveness needed if you have the hedging facility in the trading platform. The hedging can be used to close the position at any time frame instead of stopping out the position during uncertainty. Like today, they are holding simply the market. You are not very sure whether the market is going to go up or come down. In the event of uncertainty like this, either you can close the position and relook at the market fresh during the late session, or you can just hedge the position and see whether the hedging is making profit or not. and if it is not making profit for 2 hours, simply close the hedging with a nominal loss, and the buy position will definitely make more profit. So that you can understand, because there are only two types of traders in the market. Those who do the buy and sell trade, and others who do sell and buy trades. So at a given day, either a sell and buy trader might earn money, or a buy and sell trader might earn money. So ultimately, when you hold both the buy and the sell, you earn like a buy and sell trader, at the same time earn like a sell and buy trader when you use the hedging effectively and book profit on either way moves of the market. Then hedging can be used to spread the risk with limited risk in each position trading. As I explained, every 100 pips you can keep the hedging orders. You can keep the buyer limit orders, let them drop the market any level. At every 100 pips you will be able to see that order is filled, and suppose if they drop about 500 pips, then you might have about 5 positions, and each position you try to keep 30 pips hedging order, let them come down. You simply close the platform and watch by end of the month. Then you will find either all the buys might be making profit, all the sells might be making profit at the end of the month. So if all the sells are making profit, close all of them, keep another hedging order for all the buy orders at the bottom of the market, or about 30-40 pips below that of the market. The next month you will find the reversal in the market going up. Then you will be able to close all the position above their average, or one by one. So there is no need to watch the market 24 hours if you know how exactly the trading can be managed. And in most of the platform, when you hedge, they don't take additional margin. So that is another advantage. Whereas if you try to take a hedging with some other cross, then you may have to shell out additional margin for that particular position. When you are already over traded, then you may not have sufficient margin to hold the position. So you have to really take a decision. When you hedge with a cross, you have to shell out additional margin. Then the margin to hold these positions will become reduced. That gives the real threat of margin call. Then hedging can be used for a breakout trade. Suppose you find that euro is trading in the middle level. If it breaks 1.309 pi, then it could go up to 1.32. If it breaks 1.3047, it could go up to 1.296. Okay, you underestimate. Then keep a sell hedging order below that of the low, a buy hedging order above that of the high. Simply, not taking simply the position, keep only the hedging order, or is otherwise known as the entry stop order. So once you keep the entry stop order in the market, above that of the market a buy, below that of the market a sell, let them take the market upward, your entry stop will be filled, you quickly book profit after keeping stop at entry. So breakout traders can also use the hedging, the order, the type of order which is available in the trading platform, simply using the entry stop order instead of trying to watch the market to break the high and afterwards trying to jump it. Then you find you have to really jump into a running bus. Now, coming to that of the trading for today, based on these concepts, the forecast algorithm says that euro and GBP are expected to swing and rise during this session. So, what sort of trading you can do? Currently, you find that euro is trading around 1.3063 or 6264. And 1.3047 is the low. So we will try to we'll keep a buy limit order just 3 pips above that of the market, 1.4050, with entry stop of 30 pips. Similarly, in the case of GBP, 1.5677, 1.5671 is the low. So just 3 pips above that of the low, I am keeping a buy limit order. With an entry stop of 30 pips. So any level I can buy because I'm just taking a risk at any given time 30 pips. So in case I find that I have taken a highest level buy, where you take a highest level buy, and still if you keep 30 pips hedging order, then obviously nothing happens, because if they hedged and market drops continuously, it doesn't matter. I can simply close the original position with the hedging with 30 pips loss, which is very similar to that of using a stop. So the level is immaterial for us, and we can always identify that we are trying to buy near that of the low and book profit near that of the high. So I am keeping a buy limit order closer to that of the low. And in the case of CHF, it is trading around 93.53, 93.36 is the low. So you find GBP is showing negative net change, CHF is showing negative net change. So they are trying to handle the cross during the mid session. We'll keep a buy limit 0. I'm keeping 10 pips above that of the low buy limit, because Euro and GBP, when they dip, they may not go close to that of the low in the case of CHF. So I'm keeping a buy limit 93.45, 10 pips below that of the current level, entry stop of 30 pips. And yen, the spread is very low, so I'm not taking a position. Australian dollar, 1.0160 is the current level, 1.0179 is the high, and 1.0128 is the low. So market is closer to the high. If we keep a buy closer to low, they may not come down that much. Then with regard to the yen crosses, Euro yen is trading around 101.93. Currently it is trading around 101.9296, but 95 is the low. We'll keep it 95 with an entry stop of 50. So let us take a chance whether they'll fill the order which is kept around that of the low. Then in the case of GBP and 122.34 is the low. They are just keeping it closer to that. So we'll keep a buy limit order with an entry stop of 50 pips. So at the moment, Euro GBP, they are just showing negative net change in the case of GBP and positive net change in the case of Euro, in order to gain small gain or about 10 to 15 pips in the case of Euro GBP, and later on they wanted to make the drop, because this contrarian move is meant for that. So we'll take a sell limit in the case of Euro GBP. Current level is 83.33, 83.36, 83.20 is the low, 83.39 is the high. We'll keep 83.39 with 50 pips hedging order. In the case of crosses, the volume is relatively less, so you have to keep a higher hedging order. In the case of majors, we can keep 30 pips hedging order. Then Euro CHF, the spread is very narrow there again, so I already kept a limit order in the case of Euro GBP. The spread is very low in the case of Euro CHF. Let them just improve the spread between the low and the high, then probably we can enter into that. So these are all the limit orders. Nothing has been filled. They are all only limit orders I kept. And So if the market fills those orders, fine. If they fill only one or two orders, fine. I'll book profit in those orders. And if they fill all the orders also, I'll review whether they're just making a move against me. And if there's hedged, I'll review it again and see whether I'll be able to book profit with regard to the hedging, or just cut out the hedging when it is not making profit for more than 30 minutes. So whenever a position is hedged and not making profit for more than 30 minutes, you can simply close the hedging and keep another hedging order and try to see that the market goes above that of the buy order, buy position, then keep stop at entry in the buy and continue earn from that of the buy side. So suppose you have lost about 30 pips, or 5 pips in the case of closing the hedging with a loss, then try to see that you earn at least 10 to 15 pips, so that net profit of 10 pips is being realized. So I have just placed these orders. I will watch the market and track it, and you can also track it. These are all the orders. You can take a screenshot or make a note in a paper and see whether the market is giving a fill. If it is not giving a fill, I will try to modify and try to take at a higher level the buy position after watching for about 30 minutes. And in case if it is filled, then my hedging order will be working. And once the position makes profit, I'll keep hedging order and remove that hedging order. Then try to maximize the profit and close the position within the session and show you the results during the next session. So I'll come back and do that. Meanwhile, if there are questions, I'll answer to those questions. Hardly I have about 5 minutes left out. Okay. I kept the camera over that of the live market code page for us to read the market. My high and low mean early high and low or session high and low. The high and the low are set around 3:30 GMT. And that you have to note down on a daily basis. If you attend the Asian session live market analysis on a daily basis, I'm giving it, you'll be able to understand very well how it has to be used throughout the day. Then able, if spread for the pair is less than 40 pips, we don't consider the pair to trade. Yes, you are right. If it is less than 40, you can take position, but you will not end up in making any profit with the position. After waiting for about 24 hours, you may make about 10 pips. Is it a good trade? So that you can decide by looking at the spread simply. Then Anil, I know you don't use the chart for your trading system, but because most of the new traders like myself are more visual in our understanding. Yes, I understand that. See, knowingly or unknowingly, you are using the chart. See, you know that when you are in kindergarten and when you are in lower level of school, the teacher used to show the picture and say, okay, this is the thing you have to learn, an animal picture or a plant picture and things like that. That is visual effect. But once you grow up, you don't use such visuals. Instead, what you do is you read the text and develop the concept and test it and understand it and try to modify it if needed and use it effectively as your own system. So you have to inculcate that particular practice. So you can use the chart. It is nothing but the live market is being displayed horizontally in the form of up and down moves as the graph in the chart. But only thing is, we continue to refer to that of the yesterdays, like 1 week, 1 month, 1 year, 2 years, down the line 10 years and things like that. But you can refer it always in order to find the scope of the market. But for intraday trading, that is why you always find the chart. They say that read the 4 hours chart as well as the 15 minutes chart and fine tune your 15 minutes charts or the 5 minutes charts if you want to really make small swing trades. So ultimately, you can study that the market could go down or go up and things like that. But at a given time, when I buy here, will I make profit? When I sell here, I'll make profit. That is what you need to know. So at 1.3066, can I take a sell or a buy? That decision can the chart give you? Just question yourself. Is it possible for you to show these types of moves in the charts? Yeah, probably I'll just show it one of the occasions with the help of the chart how exactly these moves are done, but only for your understanding purpose, but I will not permanently use it. But I don't have right now the time to explain it. I don't put the high and the low on my chart using horizontal lines, and they help me a lot. Yeah, you can draw a line in the chart if you are used to that, but always understand that live market code page will give you the current level. The chart, if it is 5 minutes chart, after 5 minutes only the chart point is formed after taking the average of the moves in that particular 5 minutes. Then can you please go over the hedging strategy for breakout trade? I don't have much time, only 1 minute left. There are so many. Probably what I do is I'll reserve the rest of the questions for the next session, because the window will be available for me to answer to the questions during the second part of the webinar. During that time I will answer these questions, and also after discussing the results, then I'll explain more about the market moves during the US session, because there are so many questions. I will not be certainly the answer to those questions, and I do not want to rush it up. I want to really give an explanation pertinent to that, so that people will be able to understand how the market has to be read with the appropriate meaning. So I'll go back to that of the PowerPoint presentation. So I have taken the trades. You can take a screen print or make a note of these levels. I have not taken the trades. Sorry, I kept the limit orders, and I'll watch for 30 minutes. If they are not filled, I'll modify up to 10 pips and just take the positions. Otherwise, I will not take the positions. I'll just leave it as such. And in case if it is filled, I'll change it as a position and keep the hedging order. And if I am able to move the hedging order to that of the entry of the buy, then I'll keep it and remove the hedging order. Once the market moves in my favor, I'll trail a stop of 15 pips and keep a limit and try to book profit in that at the end of the session before 14 GMT. Okay. Then again, I'll review the market during US session and try to take the positions. So understand the concepts well, and I'll repeat it briefly during that of the next part of the webinar. And we'll be doing the gap time trade, and I'll explain how exactly the gap time, during gap time, they make the false move. I'll just show it to you. Then you will be able to understand how the session timings are strictly followed by that of the players as what I have given it. They are not my imaginations. They are all derived informations. Please keep that in mind. Thank you one and all. See you by 14 GMT during next part of Tracking the Forex Market Together webinar. Thank you.